Let's kick it off with Euro-Pacific's Peter Schiff and NatAlliance Securities Global Fixed Income Head Andy Brenner. Andy, your first gut feeling about some pretty significant headlines. Among them, he said that the FOMC no longer is forecasting a recession.
Absolutely, Liz. We didn't think there was going to be a recession at any time over the last 18 months. We've said that. But let me just focus. Powell started the meeting out hawkish. You know, they're not going to, every meeting is a live meeting, and he could raise rates at any time during one of those meetings. But through the middle of the meeting, he got very dovish. He told you that next week's loose report is going to be very weak. So credit is weakening. I mean, he's basically telling you what next week's report's going to be. And we saw the 5-year go all the way from, I don't know, maybe move about 7 or 8 basis points, you know, lower in yield. And then towards the end, he tried to bring it back a little bit. Ultimately, I think it was a tad dovish. But then again, that's kind of the way I see things as well.
Peter.
I'm sure Peter disagrees.
Well, I think the most significant admission that Powell made was that the Fed's going to start cutting rates long before inflation gets back down to 2%. And in fact, I think the Fed might start cutting rates even as the CPI is trending back higher. Because remember, the main reason...
He said no cuts this year, I think.
Right,
that's what he said.
Right, but he said the Fed's going to start cutting before inflation gets down to 2%.
Oh.
And the thing that's significant is the main reason we got the drop in headline CPI from 9% to 3% was that we got a near 50% drop in oil prices from the summer of 2022 until about a couple of months ago. But in the last 3 months, oil prices are up 25%. I think we're just starting a new move that's going to take oil prices to new highs, and that's going to put a lot of upward pressure on headline CPI before the end of the year, and that's also going to push a downward pressure on the economy. So I think the Fed is wrong on its recession outlook. We're going to have a recession. In fact, it's going to be a severe one, but inflation is going to get worse, not better.
Okay. He twice expressed what looked to me like extreme fear / paranoia about quitting too early. So I don't know why, Andy, you see it as dovish. Let our viewers decide. Here's how he put it.
The worst outcome for everyone, of course, would be not to deal with inflation now, not get it done. Whatever the short-term social costs of getting inflation under control, the longer-term social costs of failing to do so are greater, and that the historical record is very, very clear on that. If you go through a period where inflation expectations are not anchored, inflation is volatile, it interferes with people's lives and with economic activity, and you know, that's the thing we really need to avoid and will avoid.
He does not want to see a repeat of 1981 when the Fed kept raising rates and caused a recession, but he also doesn't want to quit too early.
Liz, 1981 was so far away from here. Rates were 12, 14, 15%. That's not a good analogy. Look, he's making the same mistake that the Fed made in 21 as far as transitory goes. They are paranoid. Absolutely correct. They're absolutely paranoid. But the reality is, I believe that they're going to be lowering rates sometime next year. As to how much? Yeah, no, they're not going to lower rates between now and the end of the year. I believe the economy is slowing down, but will not go into recession. And obviously not Peter's view. But I do think that rates are going to be heading lower. Look, 1 year ago, the Fed funds rate was 2.5%. Today, it's 5.5%. 1 year ago, as Peter just said, CPI was 9.1%. Today, it's 3%. Yeah, there's going to be machinations or what's going to happen over the next few months. But I really do think the Fed is way over their skis. Rates are too high for where the economy's going. And I think the Federal Reserve, I think the Treasury is going to have trouble paying over $1 trillion of interest rates in the future. Please,
the problem is rates are only too high because we have too much debt, thanks to the Fed. We can't afford these rates. To put this in perspective, 22 years ago, which was the last time we had 5.5% Fed funds, the national debt was $5.6 trillion.
Can we show the debt clock? Hold on. So it was $5.6 trillion for the national debt last time around. Right now, 31, let's call it 32 trillion.
It's actually 32.6. You got the wrong clock up there.
That's the live clock.
Well, I just looked at it this morning, so I don't know what you're looking at. But if you take the 5.5% interest rate back then, to apply it to the whole debt, it would have been $300 billion a year. Now, the whole defense Department budget 22 years ago was $400 billion. So interest on the national debt was about 3/4 of defense spending. Today, if we have to pay 5.5% on the national debt,
that's interest rate.
Yes, that's 1.8 trillion in interest on the debt
per year.
Yes, the defense budget is $840 billion. So now interest on the debt is more than twice what we're spending on national defense. But the problem is the debt's going to keep on rising. And so the interest cost is going to keep getting higher. What's going to cause the Fed to start cutting is a solvency crisis at the government level and also on the corporate and personal level. It's not going to be inflation coming down. And in fact, when the Fed has to start easing in the face of high inflation, it's going to be throwing gasoline on an inflation fire, and inflation is going to be making new highs. And so all the problems that Powell is talking about are going to get much worse for the middle class and the working poor, who are going to be decimated by higher inflation.
Okay, and by the way, that gasoline will probably also cost more to throw on the fire. But
Yes.
but not really. The pause, or the whatever you want to call it, the stand down from last month where the Fed did not move rates at all, in retrospect, was that a mistake or the right thing to do?
Well, there were a lot of economic numbers that were to the strong side. However, the unemployment number and the inflation number were not two of those. So in retrospect, I'd say it was a jump ball or a close call. Powell is fighting a bunch of doves on the committee, and now with Bullard gone, it's going to be less hawks. So he's got to kind of squeeze a line in there. One thing I do want to say, Peter, I agree with everything. Well, I don't agree with everything, but nonetheless, it's not the Fed. It's the U.S. government that has come to market with too many stimulus programs that have really increased the debt.
Of course, the Fed enabled that. If the Fed had not monetized all that debt, if the Fed had not suppressed interest rates, the government couldn't have gotten away with all that deficit spending. They would have been forced to be fiscally responsible years ago. But because of the Fed, they remain reckless and irresponsible. And now we're sitting on a powder keg of debt that's going to explode at any moment.
Okay, let's just talk about possible investments here. Is the Treasury market, and maybe the T-bills, the shorter-term Treasuries, are those still as attractive with the 5% coupon or whatever? You know, as you look at some of these, the 1 month, the 3 month, the at least 12 month. Hold on, Andy, and then Peter.
I love T-bills at 5.5%. You know, I mean, Rick Reeder's talking about buying commercial paper at 6.5%. Look, you can't get a better deal than T-bills right now. Yes, there are plenty of floaters or whatever, 9%, what have you. But look, I'm not one of these people that believe that you should go out to 10 years right now at 3.85. I just like, you know, accruing 5.5% for T-bills. So I'm going to stay safe. I've made some good money in equities this year. I'm going to kind of put that a little bit aside, and I'm going to kind of coordinate into T-bills.
Well, there's no safety in T-bills. I'd say there's less risk in a T-bill than in a 30-year or a 10-year Treasury. But the real rate of inflation, regardless of how the government wants to misreport it with the CPI, is higher than 5%.
Okay, so what do you go into?
You're losing. You got to get out of the dollar because that's what's being destroyed. That's what's losing purchasing power. So you don't want to own any treasuries, even short term. You want to own real money, which would be gold, but you want to own dividend-paying stocks that are not in dollars, that are outside the United States.
What about materials, agriculture?
Yes, you want to be in anything that's inflation sensitive. That is basic materials, that is energy, that is agriculture, but you want to be in investments that are going to benefit from the market being surprised by inflation being much higher than they expect and long-term interest rates being much higher than they expect. And so all this stuff that worked during the bubble days, high multiple tech stocks, that kind of stuff, the financials, that's not going to work. Okay. You've got to be invested for inflationary type stocks. So look at the 1970s. That's your a blueprint for what's going to work. See the investments that worked in the 70s and get into those.
Guys, thank you very much. We're looking at the Dow Jones Industrials, which for a minute there started to really pop its head back up above the flat line. It was up about 22 points right now. It just turned negative again. So this is a moving target at the moment.